Okay, so now that we have got a basic idea of like how forwards and futures work, what is the application of this, right? How this is being used? How do we replicate this, right? So that is what we are going to see. For that purpose, there is first one concept called law of one price. What is law of one price? Have you heard of it? Okay, it is not about two products. It is about one product only. Two products, two different products can have different price. Okay, but if it is the same product, okay, then it cannot have two different prices. That is law of one price. Okay, so your entire understanding of forward futures, okay, lies on this law of one price. Now let's look at one example. So first is your water bottle. I don't know in the video if I'm talking about any water bottle. Maybe at later point it will come. What is this water bottle? Very simple. What is the price of 1 liter water bottle here? 20 rupees. What will be the price of this water bottle in the US? Roughly, say $1. It is not $1. It will be more than that. But even if you say, let's say $1, it will be 85 rupees, right? In the US. So here it is available for 20 rupees. In the US, it is available for 85 rupees. So what will happen? People will buy from India and sell it in US. Everyone will buy from here and go sell it in the US. Okay. So now will they make a gain? They will make a gain. Why? Because they are buying at 20 rupees, they are selling at 85 rupees. Ignore the transaction cost. Even if I have to adjust the transaction cost, right? I'll make a gain. But what will happen over the time? Your demand and supply function will come into economics. What will happen? Everyone will buy from India. So what will happen if everyone buys from India? The price of this product will go up, and everyone will sell in the US. What will happen in the US? Too much of supply in the US, price will come down, right? So what will happen? At one point in time, it will so happen that there is no gain or loss by buying it from here and selling it there, right? Same product. Okay, so far there is an arbitrage gain, but what happens? The arbitrage gain will lapse over a time as more and more people do the same thing of the same transaction. It will lapse. So that is what we call it as law of one price. Even if there is a difference initially, the law of one price will come into act. That difference, that arbitrage gain or loss, people will not be able to make. Okay, one product cannot have two different prices, right, at different places, unless there is any other value addition. Are we getting it? So, for example, same water bottle will be selling for 15 rupees here, but the same water bottle is being sold for 50 rupees in your theater. Why? Because there you will pay. There you cannot say arbitrage profit. You cannot say I will buy from here and go sell in theater. There, that water has a different value. You are paying for the convenience. You do not want to come outside the theater. Only 10 minutes break is given, and you are not allowed to carry your water bottle. Right? So what happens? That is, we cannot say that is arbitrage gain. There, the water has, that particular product has a different value. You are assigning more value. Will you pay for the same water bottle on the roadside shop? Will you pay 50 rupees? Normal scenario, you will not pay. But in theater, you will not even ask. You will pay 50 rupees. Right? So, forward pricing also, we will discuss more about pricing and valuation later. But forward pricing also follows this concept where you make riskless profit. Why are we entering Epson example? What did you do in Epson example? You purchased forward contract, right, to buy the currency. What was the currency there? Singapore dollar. Singapore dollar. So you sold Singapore dollars, right? You sold in the forward contract Singapore dollar and made sure that you don't incur any risk and you are making out of that. Otherwise, what will happen? You will incur loss or gain because your exposure is uncovered. You are having a risk. That risk was not getting covered because of this derivative contract. You covered the risk, right? You made an opportunity cost. You made an opportunity gain by taking the derivative without any risk, right? Because you took a derivative, right? You eliminated the risk and you made a gain. How did you make a gain? By not losing out, by covering your exposure, right? Another simple way of doing it, another simple way of it is, I want to buy equity shares, right, of a certain company. I don't have money today, right? But after 3 months, I will get money. Okay, but I'm concerned after 3 months, the price will go up too much. So what I'm doing, I'm entering into a forward contract to buy the equity shares at a fixed price, right? So what will happen? Even if the price in the underlying market goes up, I am not concerned. So what happens? The gain that I will make on the underlying is frozen. I am entering into the contract to buy the stock at 100 rupees. And after 3 months, in the market, it could be for 110 rupees. Right? So I'm making a riskless profit. Right? Riskless profit I may make. But can this be possible? Can this be possible? Like I'm entering into a contract to buy the product at 100 rupees, but in the underlying market on that day it is for 110. Is it possible? Futures also. Futures also. What? That is okay. Margin is okay. 100 is becoming 110. So what happens? Basically, that is not the objective of the derivative market. What is the objective of derivative market? What should be the objective, supposedly? For hedging purpose, for risk management purpose, for price discovery, for liquidity, to play with lesser capital. Right? These are the objectives or benefits. Okay, you can say objectives or benefits. Basically, lower upfront cash requirements, higher liquidity, right? Price discovery, basically information discovery, market efficiency. All these are benefits, or you can say objectives also, and it helps. No, but it comes with certain risk. What is the certain risk? Speculative use. What is the risk here? Inherent leverage magnifies the realized returns and risks and contributes to the severity of derivative related losses. Inherent leverage magnifies the realized return. Magnifies means what? Multiplies. Okay, the returns. And it multiplies the losses also because of the leverage. Right? How? Let's say the margin money is very small. Right? The margin money that was required was what? How much? 5,000 rupees. On a transaction of notional of how much? Let me see. 180,000. On notional, you are playing on an exposure of 180,000, 179,000 in this example. Right? You are playing on an exposure of 179,000 with how much margin? Roughly 5,000-6,000 margin. Right? Now what can I do? I can borrow this 5,000-6,000 of margin, right? Certain interest rate. So let's say I borrow, let's say roughly around 6,000 rupees, at an interest rate of 10%. What is my cost for 3 months? What is my cost for 3 months? Huh? Calculate 1,800. How much is the interest cost? But take out your calculator, CFA calculator, laptop also if you want to open. Check in Google also. What is the interest cost? I'm borrowing 6,000 rupees. Interest rate is 10%. Hmm? ChatGPT also you can use. Me. Huh? Tea kuchcha sa? ಆಗಿದೆ ಬೋದು ಕುಡ್ಸಪ್ಪ ಕ್ಯಾಲ್ಕುಲೇಷನ್ ಎಲ್ಲ ಅಪ್ಪ பண்ணிடல. How much? Huh? 150. 600. To get 600, you were doing operating this calculator for 2 minutes. 600. And interest rate by default is on per annum basis. Any percentage by default is on a per annum basis, unless mentioned otherwise. Any percentage, inflation percentage, margin, commission, everything is on per annum basis, unless mentioned otherwise. 10% is for 1 year, for 3 months, how much? 150 rupees, let's say. So what is my cost? I'm borrowing 6,000 rupees. My cost is only 150 rupees. With 150 rupees, what exposure I'm taking? 180,000. What was my cost? What was my investment? 150. Now, how much loss did I incur? So now, what is your loss? 8%. 8 times. 800%. 800%. 150 on 1163 is how much? Roughly 800. 8 times is your loss. You thought your cost is only 150. If you see from a calculation perspective, my cost is only 150 rupees. Right? I'm losing how much? 1,200. 8 times. That is why derivatives are weapons of mass financial destruction. So what will happen? Now you say, okay, 180 rupees cost. Right? Let's do something where I'm okay to invest 15,000 rupees. On the 15,000 rupees interest, how much margin you can borrow? 6 lakhs. 6 lakhs margin you can borrow. On 6 lakhs margin, how much you can play for? 18 million. That is roughly 2 crore rupees. You can, with 15,000 rupees, your own cost, you can take exposure of 2 crores. Right? And what will happen? With 150, it became 1163. With 15,000, it will become what? Roughly 1 lakh rupees, 1,20,000 rupees. That is why we should be safe. That is why we should be cautious. Whatever we are studying is purely for academic purpose, not for practical application. Practical application, if at all, should come in your job, not with your own money, not with someone else's money also. Okay, I think I would have talked about this in my that video itself, where I'm introducing about derivatives, first video. Yes, am I talking about this, right? Without, I would have talked about without numbers, now I'm telling with numbers. That is why this statement is very, very powerful. Inherent leverage magnifies the, you can say, sir, it magnifies the gain. Yes, when you magnify the gain, when you realize the gain, it all looks good. It is like newly married. Okay, everything looks good. But if the marriage is not successful, then the problems start coming up. Then when your problems magnify, your losses magnify, severity of derivative related losses. You think only 150 rupees is my cost. On 150 rupees cost, you have incurred a loss of 1200, 800%. 8 times. Okay. So there are these risks, transparency. Okay. Basis risk. What is basis risk? Basic illa. Basis risk. Underlying what? The first is okay, transparency. What is transparency? Why transparency is a risk or a disadvantage? Transparency is a risk or a disadvantage because of your, look at the balance sheet. How the balance sheet looks. What is your underlying exposure here? Amount, roughly 180,000 notional. Right? And what is it that you are showing in the balance sheet? You are not showing that. Right? In fact, before this accounting standards came, right? This accounting standards came, say from 99 or 2000, even this was also not required. Because derivatives have zero value. Today I'm entering into the contract. I'm not paying anything literally. So I will not bring it in my books of accounts. Only when I incur a loss, I will have to bring it in the books of accounts. So until my losses magnify, I will not even show that there is an exposure. Now you have to show the loss. Notionals are not required to be shown. However, from IFRS perspective, from accounting standards perspective, you have to show in the notes to accounts. In your annual reports, in the notes to accounts, you have to show how much derivative, what derivative transactions you are entered into, what is the exposure and all, for what reason you have entered into, all those things you will have to show in the notes to accounts, but still it is not there in the balance sheet. Because 90% of the Janta, 90% of the audience will not read notes to accounts. Everything what is projected is mainly balance sheet and P&L. Right? So that is what we are talking about, transparency here. Okay, then basis risk. What is the basis risk? Basically, insufficient hedging. Insufficient hedging could be the basis risk, or your exposure to derivative is not changing in line with the underlying change. Your hedge is not effective. You have taken a derivative, but it is not necessary that the derivative value will also change same as your underlying. That is the risk. Right? You have taken 100 forward contracts. Right? The underlying price may change in a different way, and the derivative price may go for a change in a different way, because based on the volume of the derivatives, derivative price will change. Even though we are telling derivatives derive its value from the underlying, it only derives, it does not derive 100% value from the underlying. This we have to understand. Right? Even though it follows, but it not necessarily it follows 100%. Right? That becomes the basis risk. Or insufficient hedge. You are supposed to receive like how much Korean won that we saw in that example, 650 million. Right? But you have not hedged 650 million, you have hedged only 500 million. Insufficient power. Basis risk. Okay? Liquidity risk. You are not able to, you don't have derivatives for all the underlying. Okay? You may not be able to sell for the given year. You had 75 days timeline, right? In that example, you may not get the derivative for 75 days. You may get for 90 days. You may get for 2 months. You may get for 3 months. You may get for 6 months, right? Counterparty credit risk is there, right? And systemic risk. What if the exchange fails? Too much of concentration. We saw that centrally clear derivative, right? So these are all the risks. Now coming back to the example of where we said 100 is what I've entered into and 110 is the price in the spot market, right? So, but the main objective of derivatives is risk management. Main objective of derivative is hedging, but more than 90% of the transactions in the derivatives market are for speculation, right? That means people want to make money just by trading derivatives, right? Your OTC, your hedge management is there, risk management is there, but most of the transactions are speculative in nature. That causes arbitrage gain or loss practically. Theoretically, it is not supposed to be. Okay, theoretically, the derivative is what riskless cover. Riskless cover. So when we do valuations, when we are going to talk about how forwards and futures are valued, we will look at that aspect. Okay, as to how riskless position becomes when I combine a forward contract with the underlying. Okay, because my idea is what, my objective is what, risk management. So when I'm combining a derivative with an underlying, it should give me a riskless cover. That is the objective. Risk management is the objective. So when I take a derivative, it should help me in mitigating the risk rather than amplifying the risk. Getting it? Okay. So, but then that process that is possible. What is possible? Entered into 100, but after 3 months the spot market price is 110. So I'm making a gain or loss. Okay. So how that works? How that works? Let us look at this example. Arbitrage. Okay. So what I'm doing, I'm entering into, there is a spot price is 770. Okay. Risk-free rate is given, which you can borrow or lend, which is how much? 3 months time duration. Futures price is 1792.13. Okay. Now this 2% and all will become a thing of the past. Why? Because interest rates these are all US rates. Right? 3 years, 4 years back, it was 2%, 1.5%. For a long time, it was between 1 to 2% for more than 20, 30 years. But now their interest rates there also have gone up. Right? Maybe CFA Institute will also have to update the numbers, right? After, because currently it is what, I think 4 or 5% in the US also. Okay, so all this will have to be updated in which ways. I have taken the numbers that are there in your material only so that you can correlate and understand. This is also Procam only. All this is Procam example only. Okay, so what I do here, basically, I can buy today for 1770. Okay, I can buy today for 1770. And I can sell. I'm entering into a forward contract, futures contract, or a forward contract for how much? To sell at 1792.13. Okay. Now this is a riskless profit. Buying at how much? 1770. Selling at 1792.13, roughly 22. Now let us see how this works. Okay. Step 1. What I will do to make arbitrage gain or loss, right? How do you make generally arbitrage gain or loss? You don't put your money. Speculation and all, you don't put your money, right? You borrow, you take risk, you leverage, right? So here also, how it works? Borrow 1770 at 2% for 3 months, right? By SO. What is SO? By today. This is today. Okay. Enter FOT at 1792.13. Sure. Correct? Okay, buy SO or long SO, whichever way you want to look at it. Agreed? I'm borrowing money and buying the underlying, and I'm covering the risk by selling short. Okay? Then this is today. Step 2, that is after 3 months. Right? What happens after 3 months? Right? Realize FOT at how much? 1792.13 you will receive. Effectively, in futures contract, you don't receive the money, you only receive the difference. But here, for the sake of discussion, we'll say you will deliver the gold and okay, 1792.13 you will receive. Okay, then repay the loan. Tell me the loan amount. All of you should be comfortable with the time value of money. $1770 into no. Point time value calculation. 1.02 the whole power 3 months, right? Or 0.25 or 1/4. Okay, remember this will be multiplied by 100. Okay, we are doing for 1 unit only. So now, what is the gain or loss here? $13.34. Now, this is arbitrage gain. This is arbitrage gain. Now, what will happen? Everyone will do this, right? So, theoretically or even practically, similar arbitrage gain will not persist for a long time, practically also. Right? That is what we call about alpha. You saw in your portfolio management. What is alpha? Your portfolio is written over market return, your Sharpe ratio. Right? A fund manager is rewarded for that alpha only, or a portfolio manager is rewarded for that alpha only. Right? That alpha is, you can also term it as arbitrage gain. Okay, or you can also say his research capability, his understanding of the market, his portfolio allocation methodology, all of that. Right? But the moment he comes out with why, on what basis he made that alpha, right? What will happen in future? It will become difficult to make that alpha because he will talk about his strategy and all those things. So people will replicate. So what will happen? Making that alpha becomes difficult as time goes by. Then some other way of making alpha, right? For example, Titan, right, was the go-to stock for so many years, right? A more glamorous stock, gave good returns also. But what will happen now? It may not give so much of returns unless the company does something exceptionally different, right? It may not do unless the company does something exceptionally different. Now I have to look at some other stock which is at a very low level, whose fundamentals are looking good, right? Which the company is promising, the management is promising. I will have to look out that industry, that stock, and see whether that can become a multi-bagger. Okay, in real terms, not becoming multi-bagger overnight for no reason and then coming down overnight. That is not multi-bagger. Multi-bagger in the real sense is sustained, right? Giving returns over time on a sustainable basis because of the fundamentals, not because of the euphoria. Okay, so this that means what happens? Either the spot is not correct, will happen, the spot will increase. What did we say? If everyone will do this, the spot will go up. So what will happen? Everyone will buy gold today. So what will happen? The price will go up. Okay, and everyone is selling short. What will happen? This will come down. So that means effectively this difference will get eliminated. Understood? Arbitrage. Okay. So now, how do I take riskless? How do I mirror this? Okay, it's replication. Okay. How do I mirror this? It's a replication. So now what happens? Now let us say so what happens? So that is why as a next step, 1770 has now become 1783.28. The spot price has gone up in a way that it will not give that arbitrage gain or loss. Okay. So what is my step one? Same thing. Borrow how much? 1783.28 at 2% for 3 months. Right? And enter futures contract. I'm realizing futures. Tell me the loan amount. Basically, 1783.28 into 1.02, the whole power 0.25. How do you do it in your calculator? Where is your calculator? Why you did not bring? Where is your calculator? Do it in your calculator. Yeah? How did you do it? Do not do. அப்ப எதுக்கு calculator வச்சிருக்கோமா? When will you learn doing it? Tell me, where is your calculator? இது வரல. சொல்லணுமா? பத்திரிக்கை வைக்கணுமா? every class bring your calculator. Your calculator. Huh? What nonsense is this? Do not think that whatever is being told in first class will be told on a daily basis. You are expected to do all these things by default. Work out in the calculator. Do it in your calculator. Do you know? Huh? Now do it and tell me how to do it. How did you get this number? Huh? Using the calculator. How did you do it? PV, yeah. Why PV? Why do you have to do PV? Why do you have to do PV? Calculate the future value, but how I have done? Have I done PV here? Have I used the PV function? I simply multiplied, no? Then you can also multiply, right, using your calculator. Do it. Huh? No, I have used the formula here in Excel. Have I used the PV function here? Uh-huh. No, are you using PV and I and all those functions in the calculator? Why did I use that? What did I do? What did I do? I simply multiplied, no? Now you can also do, no? Why should you do the long drawn process? Y power x is the function. You have to use power function here. You know 1.02 you have to multiply, right? 1.02, right? The whole power 0.25 into 1783.28. You have to apply power function. Power function is given in y power x above the number 9. Do it. Or using power function. Hmm? 6.5. What is 6.5? 1.02. First key in 1.02. Keying in 1.02. Press y power x. That key above number 9. Then key in 0.25 equal to. You will get some number. What is that number, ma? 1.02 power 0.25. How much? 1792 Aproma code. First 1.02 power 0.25 is how much? Point. So that is nothing but this. That multiply with whatever number you. The PVFU and all is a long drawn process. You have to simply first you have to understand like how PVFU works. Here also we are calculating future value only, but you don't have to go for PVFU every time. For one step calculation, you don't have to use PV function at all. Okay, so 1792.13 gain is almost eliminated, right? Because there is not going to be any arbitrage gain or loss. Okay, when this process is followed, is only to cover. Now, what happens? Again, here we have assumed that this is effectively what? This 1792.13 is nothing but the future value of this 1783. The future value of 1783 is at 2% is nothing but 1792.13. That is the assumption here of the forward price. Forward price is nothing but the future value of the spot price. Theoretically, that is how it is calculated. Okay, and that is how it is supposed to be. But what happens, for example, in this example, we expected the forward price to be 1792.13, but what it turned out to be 1780.5. So that is where practically the difference will be. But arbitrage gain or loss will be eliminated by your economics concept, right? If you have the gain, everyone will do this, then the numbers will align in such a way that you will not be able to make that gain or loss. This is like one way of replicating, okay, wherein you are borrowing today and investing and selling short in the derivative market, right? Borrowing today, borrow and buy today and sell forward. Okay, that is nothing but this process. The same thing can be done wherein you are entering long forward and settle with future spot. What does that mean? Enter long forward and settle with future spot means what? Hmm. What does this mean? So this is what we have seen now. Borrow and buy today and sell the forward contract. So you are buying the gold today and you are selling in the forward contract, which is what we have seen here. Right? Okay. But this is a different transaction. What is happening here? Long forward means what? Buy the forward contract. Buy the forward contract. That means you are entering into a forward contract to buy something at a future date. To buy the underlying at a future date. Okay. And then you are settling it with future spot. Future means in the future by entering into a spot transaction. That means I'm telling you that I will buy it in the future. Long forward. I'm entering into forward contract to buy in the future and I will sell it in the spot market in the future. Okay, so what will happen if I'm entering in the long forward contract? Let's say that long forward is 1792.13 and the future spot is also expected to be 1792.13 based on the time value of money. Right? So this will also give the same result. Both would give the same result. Here, you are buying today and selling in the forward. In this case, you are buying in the forward and selling in the future spot market. Here, you are buying today in the spot market. Here, you are going to sell it in the future spot market. Able to understand? So these are like different ways of replication. Okay, using derivative contract, different ways of hedging. So how do I use this? For example, I do not want to buy today. Okay, I do not have money or I do not want to buy today, but I am concerned that the price may go up. So I will enter into a long forward. Right? I expect the price of this stock to go up, but I don't have money to buy. So what I do is I enter into a forward contract, freeze the price. Right? I'm freezing at 100 and I expect the price to go up to 105. So what will happen is I will settle it in the future spot. So these are different ways. These are just two different ways. There are thousands of other ways in which this could be replicated, right, using your derivative transactions and different underlying. Clear? Did we understand this? Okay. Now, what we did here was, what is this called is generally whatever formula you have learned, PV is equal to, sorry, FV is equal to PV into 1 plus R the whole power T. That is your discrete compounding. Okay, that is discrete compounding. What is discrete means? Define the number of times. Okay, yearly 2 times, yearly 4 times, yearly 1 times, yearly 12 times, yearly 6 times, yearly 52 times, yearly 365 times. That means everyday compounding. Okay, that is discrete compounding power T. Now there is something called as continuous compounding. Theoretically, continuous compounding, there is no practical instruments. I have not come across any practical instruments like that. But in practically, how they use it to do the valuation. You don't have any instrument which continuously compounds. You will have fixed deposits which compounds every 6 months. You will have fixed deposits which compounds quarterly or monthly also. you have different instruments which could compound 52 times a year, which could compound once in a year, or which could compound twice, two times, once in 2 years also, right? But an instrument which compounds continuously, I'm not seeing. But for the purpose of valuation, for the purpose of pricing, they use continuous compounding mechanism to see what could be the price if I continuously compound. So what continuous compounding means? Indefinite number, every time it is getting compounded. Every time it is getting compounded. Kanduvadi ketirukoma. What is Kanduvadi? Every one day illa. Vadikku vadi. But is that continuous compounding? That is compounding. Not so Kanduvadi is not wrong. It has been defamed. Right? The only thing is the frequency. If you do every week on week, and why the problem is because the interest rate is too high. Right? 10%, 5% per month. Okay. So that concept is different. That is also compounding only. Here, continuous compounding means indefinitely you are compounding infinite terms, infinite times. Okay. So for that, we use your log function in the calculator. Okay. Now, where do we use discrete? Where do we use continuous? Right. Generally, your question will say, okay, which to use, which not to use. But where we are talking about transactions with two currency rates and interest rates, continuous compounding. Okay, only single underlying is there, right? Like the stock or gold and all those things, discrete compounding. Where you're talking about indices, right? This index, there we use continuous compounding. It is straightforward, not complicated. Once you have to understand the calculation. Okay? So because it is continuous compounding, you use your logarithmic functions or you use your exponential function basically. So mathematically it is logarithmic function, but for your calculator it is your e function, exponential function, right? Because it is infinite terms, it is your e function. We'll see how it is done. So one concept is continuous compounding. The other one is we'll try to look at same replication, okay, with another example, okay, with a little, say, a complicated little one step further. So this example, what you are doing is you are buying or selling currency. Okay, you're going to receive, let's say, AUD, or you're going to pay AUD. Okay, so what is AUD? Australian dollar. So AUD per USD, right? Spot rate given is this much. That means your USD is home currency, AUD is foreign currency, AUD is product currency. Okay, home currency is always one. Okay, so 1 USD is equal to 1 point. That means with $1, 1 US dollar, I can buy 1.335 AUD, or with 1.335 AUD, I can buy $1, which is a stronger currency here. USD. Okay. Then certain interest rates are given. What is this interest rates? Basically, why these interest rates are required? Because I will borrow in one currency and I will invest in another currency. Okay. So 6 months AUD risk-free rate is how much? 5%, 5% or 0.05%? 5% and 0.05%, both are different. Both are different. Okay, 5% is different. 5% is 0.05. 0.05% is how much in absolute number? 0.0005. Okay, 6 months USD risk-free rate is how much? 0.0002. 0.20%. Okay, clear? What we do now, like how do we replicate this? How do we use this? Okay, now this will come in your economics also. Mostly I think this week or is covered, is it? International transaction. So this again it will come, but here little basics only we are going to talk about. what we do is basically we are borrowing in USD and lending or investing in AUD. Okay. To put it simply, very simple. What is the interest rates in India? 10%, 11%, 12%, right? Commercial borrowing, or more than that. In the US, it is 3%, 4%, 5%. So what will happen? I can borrow from the US and invest in India, right? And I can make money out of that because borrowing in US is less costly, cheaper, and I'm borrowing at 5%. I'm investing at that 12%, right? So that means there is a money that I can make, right? So how do we do that? Let's say using AUD and USD. So what I'm doing, I'm borrowing in USD, right? I'm borrowing in USD. And what I'm doing, I'm investing in AUD. Okay, how this works? So borrow 1,000 US dollars at 0.20 for 6 months. Right? You're borrowing $1,000. Sell this USD and buy AUD. Okay, how much AUD you can buy? How much AUD you can buy? You can buy 1,333.5 AUD. You will invest this AUD. Okay, you will invest this AUD for the time given. Okay, getting it? Today what I'm doing, I'm borrowing 1,000 USD, converting it to AUD. The amount that I'm getting is 1,333.5 AUD. I will invest this AUD, make money from AUD, right? Then what I will do? Convert to USD, right? And repay the loan. So two steps I've told, right? 3 steps: invest or lend AUD at so and so percentage for so and so time frame. Now you tell me what will happen after 6 months. Work it out quickly. All this is there in material as well. Work it out. Unless mentioned, it is per annum. will be the first step in the future date? How much will be the value? AUD investment value. How did you get that number? Then that is today's rate. That rate is not given. Right? You will convert after 3 months or 6 months. That rate is not given. Okay. So that exchange rate is not given. Okay. So that you can leave it. So you will convert that and you will get USD, right? Okay. And you will with that USD you will repay the loan. So how much will be the loan value? USD loan value. Thousand into. How did you get that number? 1000 into 0.1.0002. 1.0002. Okay, you should have 4 decimals in your calculator always. 1.0002, the whole power 0.5. 0.5. I'm sorry, 0.002. Correct. Okay. Yes, got it, everyone. So you will receive AUD. Okay, and use exponential. Okay, in which ways? So what you will do is you will basically use our E. Okay, you'll use your raise it to ERT. How do you do your continuous compounding? Is equal to PV into E power RT. Okay, this is also called as PERT. What is PERT? PERT. It is referred to as PERT function also. Okay, for PERT calculation also. How do we do this? Right, in your calculator, basically what are the numbers here? What is the present value for AUD? This is this one, right? 1333, right? 1333.5 into E is what? Okay, you are having E function. So first what you will do is, first you will do the right side function. Okay, RT. What is the rate of the interest? What is the rate of the interest? AUD 0.0005. Okay, 0.0005 into T is what? Into 0.5. Okay. So first you will do this function the way you did here also, right? What did you do here? First you will do this part. First this part will come. Okay, so same way here also. First this part will come. Okay, Then what will we do? So point 0.0005 into 0.5, this you will calculate. Okay, raise it e to the power this number. So basically, first make it 0. First e power is there, exponential. Exponential should be in the second key. So you have to use second key, right? E to the power. Do that, then multiply this number RT. So second, then what is that key? ln, logarithm. Okay, second ln, then this number 0.0005 into 0.5. Did you get? What is that number? Forget this number alone. E to the power this alone. 1 point something will come, that into this. Okay, so basically yes, this is the number we are getting. So what is the difference between this number and the other number which you got first? So first you use this number, right? FV is equal to PV into 1 plus R the whole power T, right? With that, what is the answer? Continuous compounding, and in terms of discrete compounding, SV is equal to PV to 1 plus R the whole power T. Okay, so into 1.005 the whole power 0.5. Both are same, huh? They are not same. But very small difference, right? We can ignore. This is only for how much dollars? $1,000. If it was for 1 million, if it was for 5 years, it's for 10 million, 50 million, 100 million. Then there is a difference. Very simple thing, no? You do this calculation. 100 invested at 10%. Okay. Yearly compounding. What is the answer? What 10? 110. Okay. 100 invested at 10%. Continuous compounding. Calculate. Is equal to 100 into EXP, what? 0.1. 0.1 for how many years? 0.1 into 1. You see, this will be more than semi-annual compounding, which is better. Yearly compounding is better, or semi-annual compounding is better, or quarterly, or monthly, or daily, continuous compounding. Okay. So now what happens? You have received USD. At what rate we are going to sell, we do not know. How much we need to repay? So have you got this number? Repay USD loan, right? So I have to repay USD loan, right? Essentially, my exchange rate has to be this. That means when I'm selling the AUD, I should receive the same USD value. If not, there will be an arbitrage gain or loss. Getting it? So the exchange rate that is arrived at is like this. Are you getting my point? This exchange rate to avoid any arbitrage gain or loss. For example, 20 rupees water bottle here, 85 rupees there. There also it is 20 rupees here, and there it is 85 rupees today also. After 5 years also it will be something similar. What comes in between? What deters us from buying from here and selling it there? Arbitrage illa. Exchange rate. Exchange rate is such that it will move in such a way that you will not have incentive to buy from 20 rupees from here and sell at the exchange rate there. Exchange rate will move in such a way that you don't have any incentive. That is how exchange rate is derived. Similarly, the same thing here also, by borrowing in US and investing in India, you will not have much incentive because the exchange rate will move in such a way that you will not have any arbitrage gain or loss at from a big picture level. Don't come and tell me when my friend went to US, I gave him one water bottle for 20 rupees. He sold at 85 rupees, gave me 65 rupees. Okay, think from a transactional perspective, commercial transaction perspective, it will not make any sense. So what happens? Sell AUD, buy USD. At what rate will I sell? At what rate will this foreign exchange transaction will happen? This will happen at this rate because I have to repay the USD loan value is so much. After 6 months, the USD value is so much of the equivalent of this, right? The exchange rate will move in such a way that this exchange rate will become like this. This is also called as Fisher effect. If I'm not wrong, you will study this in your economics also. Using interest rates, you are arriving at exchange rates. Using exchange rates, you are arriving at forward rate. International Fisher effect, you will see this in your economics also. There is a formula for that. 1 plus I divided by 1 plus R. How to arrive at forward contract, forward exchange rate, forward currency rates. This only, that is this. So one transaction we saw with your normal underlying say gold or whatever be the product, right, with a forward contract. Another one we have seen is one with the currency exchange rates. Clear? This one is clear. Okay. Now 1.335 has become 1.3325, right? So AUD has appreciated or USD has appreciated? AUD has appreciated. Why? We need less number of AUD to buy, right? Or other way around, with 1 USD, I was able to buy so many AUDs. Now I am able to buy lesser AUDs, right? This is one reason. Second reason is also your interest rates. Which interest rates are lower? AUD, right? The currency whose interest rate is lower will become stronger. Okay, for example, US and India, whose interest rate is lower? US. Which currency is stronger? Okay, so that is also one understanding out of this, right? RF minus RD, if it is less than 0, okay, then your foreign currency is expected to be stronger. Or very simple, if my foreign currency interest rate is less than the domestic currency interest rate, then foreign currency is expected to be stronger. The currency which has a lower interest rate, that is expected to be stronger, that will go for a premium. So this summary is there in your material replication chapter. Check. Arbitrage and replication chapter, third or fourth chapter? Fourth. Go there. There is one summary, one table is there where they will say RF minus RD is less than 0, something like that. Exhibit 6. Check. Example 6. Huh? Example or exhibit?
Exhibit 9.
Exhibit 9. Check exhibit 9. Okay, so if RF minus RD is, if RF is less than RD, okay, there I don't think they are talking about RF less than RD. They are confusing RF minus RD. So there you can also write with your pen side. If RF is less than RF minus RD, what they are telling, if RF minus RD is less than 0, that means what? RF is less than RD, negative. And then, so what is the next thing? Basically, okay, replication, arbitrage. Then all along we have seen that there is no cost and benefits with the underlying. Okay, there are no cost and benefits with the underlying, but there is always certain costs and benefits with the underlying. For example, your stocks have a benefit. What is the benefit? Dividend. Right? Your metals, your commodities have a benefit. What is the benefit? Or what is the cost? Storage cost. If I am talking about gold, then there is a storage cost. So that has to be considered. So when I'm entering into a derivative, right, instead of buying the share, instead of buying the underlying, I am buying the derivative. Will I get the dividend? I will not get the dividend. So that dividend, the underlying fellow is enjoying. So that has to be addressed in the pricing. Similarly, I am buying gold, so physical gold. So that gold has a cost. Storage cost is there because of the nature of the product. I have to protect it. I have to safeguard it, right? So there is a storage cost. Now, if I don't buy the underlying gold, I buy the derivative. Then will I incur that cost? Right? So that has to be priced in. Oil, right? I buy oil. Oil I have to store. I need tankers. I need the storage capacity, right? But if I do not buy oil, underlying, I buy derivatives on oil. In which case, will I have to incur the storage cost? I will not have to incur. So accordingly, the pricing has to change, right? So that means in the pricing of all your forwards and futures or any derivative, we call this as cost of carry and benefit, right? Carrying the underlying and entering into derivative, there is a difference, right? So that cost I will not incur or that benefit I will not enjoy. Accordingly, my price will have to change, right? So this we will see when we are talking about the pricing of your forwards and futures, probably in third class from now or maybe in the next class. Okay, so we'll discuss this aspect. This is included in your replication chapter, but I will do it when we are doing valuation of forwards and futures. Okay, so any doubts? Clear. Okay, so we have roughly covered around 4 chapters in your derivatives. If that a little bit is pending I think options basics is covered in these 4 chapters. That I will do separately. But excluding options, excluding contingent claims, more or less I have covered. Okay, you can make sure that you are going through and understanding. All right, any doubts? Okay.
What is
RF, risk-free rate. RF RD. This one is okay. This one is okay. Basically, RS risk-free rate. Here, RF means foreign currency. RD means domestic currency.
USD
Yes, yes, same only answer. Discrete compounding is used individual underlying assets. Continuous compounding is used indices. Then the underlying is index or FXs with 2 interest rates. Yes. So what? Yes, they have been making that arbitrage gain, but for that, so that is where over a period. Now this has been happening for last 30 years. Okay, but somewhere that gain will get eliminated. Somewhere that gain will get eliminated. Japan was having negative interest rates. That means if you borrow means you will get paid. That is how it was. Okay. So arbitrage gain, it is not that arbitrage gain is not there. Right? Efficient market arbitrage gain should not be there. That is the whole point. For derivatives, the purpose of derivatives is what? Risk management, not speculation. But it has become the other way around. That is why arbitrage gain exists.
also in that case, Japanese borrowing rate was lesser, very less, right? So we can't assume that the currency will be strong as the assumed here.
So again, there are a lot of other factors also that play. Okay, this is more purely if I talk about connection between interest rates and your inflation. So keeping these 2-3 things in mind, we are talking about this. But it is not only that is where we have multi-factor models, right? You have to consider other factors also. A lot of other factors are also considered practically. For that only you get money return, right? That is what we call it as systemic risk, systematic risk. Because this risk exists, that is why you want to take that risk. For that risk only you are rewarded. You are not rewarded for the risk which can be eliminated by yourself. Clear? Okay. So we'll close here. We'll continue mostly tomorrow. Okay. I'll keep you informed in some time.